What's up, guys? Should we pay down debt or should we invest? That's always a dilemma on your path to financial independence. Pay down debt or invest. Well, welcome back to the MD Investor, the channel where we talk personal finance, increasing our financial IQ, teaching our children so we can break the cycle of generational poverty. So, should you pay down debt? So, what should you prioritize? Should you prioritize paying down debt or investing on your journey to FI or financial independence? Again, this topic is going to always come up. Unless your person has zero debt, and congratulations to you. But it's going to come up, right? It's very motivating to invest. Absolutely, no question. To see your asset column growing, to see your dividends come in, to see the growth of your portfolio, picking your portfolio, researching, all that is all good, and it's very motivating. And that's the fun part on the financial journey. But what benefit is there if you're making 8, 9, 10% on your investments, but you're paying 16, 18, 20, 25% to your credit card? Right? It makes no sense, right? You are, all of the benefit you gain from your investments are being eroded by the drag of the debt you have. So there is the dilemma, right? There's the dilemma. Your debt is a drag on your journey to financial independence, right? It can pull away all of the progress, all of the gains you've made from your investments. So, like a lot of questions in life, should you prioritize paying off your debt or invest? It depends. I know that might not be an answer that's satisfactory, but it really does depend. And what does it depend on? It depends on how much is your debt costing you. In other words, what interest rate are you paying on your debt? If you have a very high interest rate on your debt, for example, consumer debt, credit card debt, notoriously very high. It could be in the 20s, right? 25%, depending on your credit score. That's a very high interest rate. You're unlikely to get this rate of return on your investments. So in fact, if you're getting 8, 7, 8% on your return and you're paying 25%, it's better to pay that debt off. It's really better to pay that debt off. It may not be as fun, but it's practical, and in the long term, it is a necessary step on your journey to financial independence, right? So just think of someone that has $10,000 in the bank, right? They have $10,000 in the bank, gaining negligible interest. You already know, and they owe $9,000 in credit card balance. That credit card balance it's going to have a very high interest rate, right? So $10,000 in the bank, $9,000 or $10,000 in the bank, which is assets, $9,000 of liability, which is their credit card debt. So their net worth is positive $1,000, right? You may say, yeah, well, they could take that. They could take out the $10,000 and put it in stock market and get a higher rate of return, but it likely won't be as high as the interest you're paying on the credit card. The best move in that case for that person would be to take $9,000 out of their $10,000 and mail it into the credit card, pay off that credit card debt, because what they have is an illusion. That $10,000 bank gives them an illusion that they have money, but they really don't. You see on paper, it's $10,000, but they have $9,000 liability. right? So their net worth is $1,000, but it makes them feel, yeah, it may make you feel like you have money, but you really don't. So because that interest on that 9,000 is so high, it makes no sense. It would be different if that $9,000 that they owed is, let's make stuff up, like it was either an interest-free loan from a family member, or they're only paying 1%, and then they can invest in 10% and make, and they could invest in 10,000 and make 10%. That'd be different, right? That'd be a lot different, because then they'd be positive 9%. 1% they'd be paying on their debt and gaining 10%. But that's not the case, right? That's what they call interest arbitrage, where you borrow money at a low interest, invest it at a higher interest, and that difference is the gain that you're making, right? So when it comes to deciding paying off debt or investing, it depends on what the debt is cost to you. In other words, it depends on the interest rate. If you have a very high interest rate, it's better to pay off the debt before you start investing, such as credit card debt or any consumer debt, furniture loans, all these things, pay them off. If you have a debt that is a lower interest rate, so maybe something 3-4%, maybe for your car or something like that, you may maybe not want to pay it off. There's no rush to pay that off. Again, right? So some people use numbers like if it's 5% or above 5%, pay it off before you start investing. I think that's a good number to have in your mind. Anything above 5%, probably let's pay it off. 5% and up, sure, let's pay that off. Okay, and then the benefit of that is now when you start to invest, you don't have that drag on you. So a mortgage or something like that, 3%, 3.5%, 4%, no rush to pay that off. Go ahead and invest. Why? Because the money you would invest can get a higher return than 3-4%. Okay, so no rush to pay off your mortgage. Anything 5% or lower. If it's something, like I said, I get something above, then you may want to pay that off. The exception I would add here is your retirement. If your company has your 401k in your job has a company match, meaning if you invest in your 401k, they will match it. They'll have dollar for dollar, or they'll match up to a certain percentage of your income. In that case, I'd say invest, because if you don't invest, they're not obligated to match. I would say invest, even if you're in debt. I'd say invest up to the company match to get the company match, but then no more. Invest to get the company match. So if you have to invest 5%, invest 5%, get the company match, but don't invest anymore. The remainder, attack your high interest debt. I think that's a good way to think about it, because the debt is something that has to be addressed. After your company 401k, after you invest in your company, after you invest in your company's 401k up to the match, then you have to get an emergency fund just in case stuff happens. So whether it's, people talk about 3 months, people talk about 3 months of expenses, people talk about 6 months of expenses. Some people say if you can do it, 12 months of expenses. I mean, that's a lot, but you need to have an emergency fund, at least, like I said, 3 months of expenses, just in case. Just in case you crack your rim, just in case your transmission on your car goes out, just in case your brakes go out. Anything that may happen, that if you don't have an emergency fund, you're going to have to go and swipe the credit card. You're trying to prevent that. So 3 months living expenses would be good. 6 months would be better if you can. And those are the first 3 steps that I think is smart on your way to financial independence. So again, we're going to end the decision to whether we should pay off debt or invest. We're going to think about the interest rate, or what the debt is costing us. 5% and above, is a good number to have in mind. We should attack that debt. You want to invest in your company's 401k, especially if there's a match, up to the match. The rest of the money you can use to attack the debt. You also want to have an emergency fund of at least 3 months of expenses. Could be up to 12 months of expenses, depending on what you can do. Then, after that, you can have fun and begin to invest. Again, guys, the MD Investor giving you another video to increase our financial IQ so we can teach our children and finally break the cycle of generational poverty. I'd appreciate a subscription, and I will see you on the next one.